Unrivaled Nation, is it finally game time for Fannie Mae and Freddie Mac shareholders? Both stocks popping higher today. I previously called out Fannie Mae at the end of last year in a public YouTube video. You can check it out yourself. And since then, Fannie Mae, ripped higher. I called it out as potentially one of the best ideas for 2025. Since then, up over 200%. This was largely based on the thesis from billionaire investor Bill Ackman. Sort of walks through what the business does along with the valuation framework. Super concise, if I were to boil it down into 10 seconds, is that these are very lucrative businesses generating tens of billions in profits. They trade at very low multiples to their earnings because of the uncertainty of what they look like post, exiting conservatorship or post exiting the great financial crisis impact. So that's the uncertainty. It trades at a very low multiple to normalized earnings. And if you're able to get some sort of normalized multiple in the future, you might have a much higher share price. That is sort of the thesis to understand it, is that if you remove the uncertainty of how much does the government actually own, then you might be able to say, wow, there's hundreds of percent upside. And that was the initial thesis with Fannie Mae, but there have been some developments that are getting quite interesting. For example, just this past weekend, we saw Bill Pulte, who's overseeing Fannie and Freddie, reposting President Trump's AI-generated image. So this is President Trump. He's I gotta admit, I'm looking at this picture and I kind of, there's sort of this meme of once you beat the game, you start going on these side quests. I get the impression from this meme that he wants to be on one of these side quests of going on the New York Stock Exchange and be like, look, I listed Maga. Look at that, because there's a lot of clues about this image. Like, they're very particular about this AI generated image. One is, first of all, the Great American Mortgage Company. So this is alluding to Fannie Mae and Freddie Mac. So possibly a combination of the two. Turn it into Maga. So everyone with dyslexia, now you're going to be really confused because it's like GAM, mortgage, whatever. So you're going to say it's Maga is the ticker, even though the G becomes whatever. And so Maga is possibly the combined entity and looking for a New York Stock Exchange listing and November 2025. So they're working on it now. In other words, they're actively, how do we get this to the public? He wants to be ringing that bell. Ring a ding ding. Very interesting to see. So this post is what caused the stocks to jump higher today. And as you can see, there's a lot of data points just from that picture. So this comes after, a couple of news items, one of which is that several bank chiefs, for example, from Citi, supposedly from JP Morgan, have been meeting with President Trump to talk about issuing some of the stock. And maybe he concluded it would just be easier to do some sort of combined vehicle, the Maga vehicle that he's going to be issuing stock from that would combine Fannie and Freddie. Who knows? The rumors, this is once again from the Bloomberg article, is that the combined value of these two giants is around 500 billion or more. I would argue more, possibly 500, 600 billion. We'll talk about that in a second. That's a big part of this video. And that they're looking to sell between 5 and 15% of their stock. So possibly raising, if you're looking to sell, let's say if you conclude that the valuation's around 500 billion, it's easy to see how you're getting $30 billion in capital that you're raising for the government. I mean, that would be a huge, accomplishment for this administration. Clear bragging rights. So then you have Bill Ackman, and he's getting back in on the meme train. And he's reposting about someone who posted, "Dad, how did you get so rich?" And he wrote, "I invested heavily in Fannie and Freddie after they got torpedoed and pillaged by the U.S. government. I knew conservatorship wouldn't last forever." And then the little boy sitting at his knees goes, "Frickin' legend." So amusing to see. But the real case, and as Ackman subsequently tweeted, is that there is actually a lot of excitement and potential between merging Fannie and Freddie. Huge synergies in that you could save a lot in their operations, possibly getting lower spreads, lower costs for their core business, this mortgage guarantee, And if you're able to get a lower spread, a lower cost, maybe you could also get lower mortgage rates if you, in theory, combine these both entities. We'll see. But a big part of this is actually lowering the costs of the actual oversight. Instead of two entities, you're going to have one. Arguably, you won't need as many bodies running these businesses. So you could have a situation where, because if you, in theory, create this Maga vehicle that combines it, maybe there's a lot of layoffs at one or both of the entities, because now you're saying, well, we don't need all these bodies for very similar businesses, and you can get higher profitability. And then, or you say we can do also lower fees. So therefore the consumer wins, lower fees, lower costs, let's say roughly the same profitability. So there's a lot of different ways to spin this. Very interesting development. And he's also saying, look, if this is President Trump's idea, it's a really good one. Let's frickin' go. That's what Ackman's saying. He's obviously got billions on the line with this, so he's excited about this. So the question is, will Fannie Mae, Freddie Mac, FMCC combine, form Maga? That's a bit of an uncertainty. I can't answer that with precision. It also gets super messy. My general focus is on Fannie, but arguably the benefits that you'd get from a merger would result in Fannie doing even better. And we'll talk about those dynamics in a second. First of all, none of this is financial advice. I'm just sharing my personal take. In full disclosure, I do own a stake in Fannie Mae, the legacy shares. FNMA is the ticker. Also, just earlier this morning, Justin wrote, "Thanks for the great content you've been putting out. I've really enjoyed learning from you about investing over the last 4 years that I've been a member. I love seeing the Unrivaled Nation sticking with it and enjoying it." This follows Harish, who said, "You bring immense value with your non-biased insights and a strong focus on fundamentals. The profits I made from just one of your letters have already covered the premium subscription for several years. So if you're looking for compelling ideas, come check out Unrivaled Investing." And so when I think about my checklist, this is the checklist I run on every company I look at. The challenge is that I would say Fannie Mae, Freddie Mac, focusing on Fannie Mae because that's what I own, it really doesn't pass this. I would much rather have something where it's very clear management has this huge skin in the game. You have founder-led. Maybe they've done it before. So this is, I'd argue, a special situation. And there's a room in my portfolio, as I'm thinking about how I'm allocating capital. There is room for special situations where I'm saying, yeah, I might lose a lot on this, but the risk reward strikes me as asymmetrical. So just dramatic upside versus downside. That is what I view with Fannie Mae. It's already up significantly so far this year. And so recognizing this isn't going to be the bulk of my portfolio. But I want to make room for the occasional special situation that gets me excited. I get probably more excited with the founder ownership companies that or the hugely aligned management that just deliver over time, but there's room for both, in other words. So let's go through Fannie Mae, thinking about the potential here, along with Freddie Mac a little bit. So with Fannie Mae, last year doing around $17 billion in earnings. The year before that, a little bit more. You can see a net worth around $100 billion. And you could see administrative expenses of over $3 billion for the last 2 years. Think about that. Those are the operating costs, the people to run Fannie Mae. $3 to $4 billion a year. Very rough napkin math, 17 times earnings. That's a huge discount from, let's say, the S&P 500 trading in mid-20s. On 17 billion, you're talking about a shade under $300 billion in value, market value, enterprise value for Fannie Mae. That's how I'd think very roughly about this. Freddie Mac, another sort of ballpark napkin math, let's say around $12 billion in earnings power. Yet again, around, let's say, $2.5–3 billion in administrative fixed costs, people expenses, professional services, technology, occupancy, salaries, employees. So there's a lot of duplicative costs there. Once again, 12 billion, let's say a sub-market multiple of 17 times is a very stable business, very lucrative business, still giving it a discount to the market because you're not talking about hyper growth. You're still talking around a $200 billion value. So very easy to see, arguably, Fannie Mae arguably is worth a lot more, closer to $300 billion in value. Freddie Mac, closer to $200 billion in value, 300, 200, 500. That's how you're roughly getting those figures that you're seeing in the news about hey, is this combined going to be around $500 billion, and they issue, 5% and get 30 billion, 7%, something that gets 30 billion in capital or more. So thinking about these two pieces, let's say 15, 16, 17 billion from Fannie Mae, another low teens billions from Freddie Mac. If you were to strip out some sort of fixed cost because, hey, in a merged entity, you're not going to need all these, let's say, offices. Maybe you consolidate. It's the example of there's clearly a lot of administrative expenses in both, between $2 to $3 billion or $3+ billion in the case of Fannie Mae. If you're able to strip out a couple $1 billion and maybe even lower your fees because of this synergy benefits, the consumer wins from lower fees. Investors win because you have a now leaner vehicle that, is looking at more profitability in theory. So if you're able to strip out some of those costs, maybe, just maybe, you're talking about an entity around $30 billion. After all, let's say 17 billion Fannie Mae, maybe it's closer to, 15 billion plus, another 12 Freddie Mac. So now you're talking about high 20s, strip out a couple $1 billion in these duplicative costs. Now you're talking about closer to $30 billion in potential earnings per year. And that's, very clearly how you can get to a huge pie. This is the challenge though. This is where it gets extremely tricky. So $30 billion in earnings, clearly, that's the multiple that you need to think about. If you have $30 billion in earnings, is it 15 times? Is it 20 times? 20 times 30, you're talking about $600 billion value. So that headline $500 billion might be on the conservative side. It might be 600, might be more. So that's one thing to think about. The other, key aspects to think about, and this is where it gets, as I mentioned, super tricky, is because of the 2008 bailout, the U.S. Treasury owns just under 80% of the equity through a warrant. So they when they want to exercise this warrant, they're getting 80% of the pie. Plus, they have this liquidation preference from their preferred stock that for each company, so for Fannie Mae, Freddie Mac, is over $100 billion. So just think about this for a second. Like very roughly, okay? If you have a pie that's $500 billion and the government's claiming, hey, we get 80% of that, okay? That's $400 billion, ballpark, okay? Then you're saying, oh, and we also have this other claim that's over $100 billion. That's a way of saying, yeah, I want the whole pie. I want 100% because of that prior bailout. Now, I'm a little skeptical that Uncle Sam is going to eat the whole pie here. Partly because on their own website, which Bill Pulte oversees, they call out, yeah, this company, it needed money during the great financial crisis, and it got about $120 billion, but it subsequently got repaid $180 billion. That's that Treasury senior preferred. So this $100 billion claim isn't really right because there was this cash sweep. We were repaid. We effectively got 11% return on investment. So we already have 80% of the pie. Should we really get 100%? I don't think so. I don't think that was the original terms of the deal. Could they do it? Yes. And that is the challenge that investors face, is that this is a situation where should the government conclude, hey, we're writing down $100 billion preferred, you're going to have people on the opposite, side of the aisle say, look at this handout to Wall Street, $100 billion handout to Wall Street. That is not the case, in my opinion. Fannie Mae already paid it back. What are you talking about in terms of that still being outstanding? That said, it's one of those like Darth Vader moments where, the best Star Wars movie, Empire Strikes Back, where, Lando's like, this deal stinks. It's constantly changing. And he goes like, pray that I don't change the terms of this deal further, and that's the challenge is could you have, the government effectively say, here's the terms. We gave you money. We're dictating the terms and we actually get 100% of the pie. Or does it, go back to what it was originally intended with that 80% warrant? Why? if you're going to go through 80%, why not? If you really want 100%, why not set the warrant to 100%? Like, so there's those elements to it where I think it was intended, and that's clearly what Bill Ackman believes. So let's focus on Fannie Mae, because frankly, doing this sort of combined Maga vehicle would be it's very difficult to sort of pencil it out. But let's stick with Fannie Mae, just partly because I own it, I'm interested in it. So I'm thinking about earnings power, ballpark 15, 17 billion. I see one conservative side closer to $13 billion. Assume a range of multiples, 15 to 20 times. So that gets to the value for Fannie Mae as somewhere between $200 billion, $350 billion. So the shares outstanding are around 1.1 billion. The warrants for 80% that can exercise to 80% gets around 4.7 billion. And they call out that their fully diluted share count is just under 5.9 billion. So then we assume, okay, what's the amount of value that's potentially going to legacy claims, maybe junior preferred, maybe the government wants a little bit more. This is my ballpark for how this could play out. Maybe it's all wrong. But if you assume, let's say, roughly $30 to $40 billion goes to junior preferred and other claims, that the senior preferred gets wiped out, as I think it should be, then you're looking at a scenario where even after Fannie Mae stock has rallied, it can still go up several 100% from here. In one case, closer to 400%. And that's the reason why I still own it, even though it's ripped higher. But I'm also not making this an all-in position, because I don't like companies where A, you have this legal uncertainty, B, you could have this huge downside. Now, I'm clearly stomaching the legal uncertainty to buy a stake, and that's what creates this opportunity to have this sort of low valuation multiple. But it is this question mark of, how much will the government want? And at the end of the day, I'm effectively assuming that the legacy Fannie shareholders will still own somewhere between 15 and let's say 20% of the new Fannie when it gets relisted. Now, this framework arguably has even more upside potential, assuming the fat Uncle Sam picture doesn't take over and gets 100% of the pie. There's more upside potential if you have that sort of Maga situation where they're merged together, you have synergies, investors like it, maybe it's closer to that 20 times multiple. And plus, keep in mind, Fannie Mae generates more of the income than Freddie Mac. So, they would get a little bit more of the pie. They have a higher net worth. So that's how I'm thinking about it. From here, overall, I find this setup to be very exciting, very interesting. It's not my traditional checklist. It definitely goes into that special situation bucket, but I think we will have some sort of conclusion by the end of this year where either, it's zero or hero dynamic for this special situation bet. I hope this video talking about Fannie Mae, roughly Freddie Mac, the great American mortgage company, the Maga potential stock, has been helpful for you. Thanks so much for tuning in. My name is Daniel. You're watching Unrivaled Investing.